Good morning, friends. Good afternoon, actually. So welcome you all to the next knowledge session from the Digital Fifth in collaboration with ZIGRAM. I'll just give another 1 minute for the people to join in. I think people have been joining in and the room is getting filled up. But still, I want to give a 1 minute time to others to join in. So I think this is good. So let the people join in, but we'll get started on our session. So thank you guys again for joining us our knowledge sessions, and it's always pleasure to exchange the knowledge with you guys and learn from you also. So this time I've been joined by CEO Abhishek from ZIGRAM. He will introduce as we move on. So Abhishek, request if you can just put up the slides and then we get started. Yeah, guys, I think I don't need to set a context of the AML KYC. It's always a hot topic and it's getting hotter day by day. That's the way the summers continue to keep getting hotter. It's getting hotter. So this time we try to get in a different dimension to the whole of the AML KYC. So but definitely we try to understand that how the AML regulatory development is taking place in the country. But more this time we want to focus on how the fintechs and bank relationship having an impact on the AMLs, because it's continued to grow. The collaboration between bank and fintech across the products is continued to grow. And how the fintech AML program should be built, like what are the different components? And it may not just specifically limited to the fintech, but also to the bank, NBFCs, whosoever the regulated entities. And then understanding that what are the gaps and how to solve them about. And that's where the Abhishek will walk us through in the whole of the process. Abhishek, just next slide. Yeah. So why don't you introduce yourself, Abhishek, and the company also?
Thanks, Shashank. Good afternoon, good evening, everyone. My name is Abhishek. I'm the CEO and co-founder of ZIGRAM. I represent ZIGRAM, which is a RegTech company focused on 3 areas: anti-money laundering, financial crimes compliance, and emerging risks. We're now about 5 years old, close to about 400 full-time folks. And we are one of the few companies in the world that offer the integrated RegTech stack, which means we build our own tech, data, and solutions, as well as services, just to solve problems on AML, financial crimes, and emerging risks. My background is that I work with organizations like KPMG, Dun & Bradstreet, BMR Advisors, and I've done AML implementations in banks, financial institutions, and others globally. In addition, I'm ACAM certified and I sit on the advisory board of ACFCS in India. That's a quick introduction about me. Very excited to be here.
Thanks, Abhishek. And just quick introduction from our side. Myself, Shashank, I've worked with Wipro, L&T, and then worked quite good part with the DCB Bank, where I was responsible for the governance and compliance from the technology perspective. I also continue to build on the digital banking, the fintech partnership. I'm part of the Digital Fifth, which is fintech and digital consulting firm, which works very closely with the banks, NBFCs, and the fintechs into helping them with their different digital technology advisory, as well as on the risk and compliance. In fact, right now also I'm working with one of the NBFCs to help them do various regulatory compliance demand, which comes more from the advisory perspective. So that's what we do. And Abhishek, if you can just quickly go to the next slide. And the broader services, I don't want to take much time, but we help the banks and fintechs and NBFCs on the digital transformation, digital roadmaps, benchmarking of the products. Quite good on the open banking advisory with related to the API product development, API roadmap. We also work with very entity on the digital research and content management. If you want to see our latest report, you can go to visit on our website, and where that you can see lots of the deep insight on the RegTechs, what's happening. And we work a lot with fintech and startups, security and compliance services, and then also in technology advisory. So that's all. And now is immediately straight jump to the topic. And meanwhile, guys, if you have any questions, please put up on the chat box. In time to time, we'll keep taking a short break for the people to ask the questions. But in case if you have any questions, please share on the chat box, and me and Abhishek will try to pick it up during the sessions. So let's just set a context that what is anti-money laundering, the evolution has taken place, and then we got into the fintechs part. So if you look at the KML KYC objective, if you look at it, the government of India has already laid down the Prevention of Money Laundering Act, PMLA. And to enable the implementation of the act, all the regulators which are there in the country for their specific segment, they lay down the guidelines for those entities working under the regulations. And that's where the RBI for the banking and finance segment, for the NBFC, RBI put out all the guidelines to make sure that every entity is aligned to the PMLA Act guidelines, right? And that's where the continuous changes keep on taking place, enhancement keeps on taking place. That's where we have seen. And when Abhishek he will talk about that whole of the evolutions. Abhishek, can you just, in the recent, some of the major ones, because 3 years, lots of the changes have happened, but the recent one, which has the major impact, like say, put that lots of the emphasis on the customer due diligence process, especially on the transactional side of it. So that's where and I don't want to spend too much of time on this, guys, in case if you have a question, we'll pick it up, but that's where just to set the context. So this was where that and entities also, like for example, merchants, the sole proprietor, or it could be the MSME, those all have brought under the entire the process of the customer due diligence, right? That's where there, and some of these guidelines on the threshold limits was also changed. Very detailed due diligence process has been put for the non-face-to-face customer onboarding. And this was a massive change, right? Where the video-based customer identification process were laid down, be it on that lending product sale, or you're talking about the deposit acquisition. That's everything was changed. I think Abhishek, I think slides are moving. Sorry. Yeah. Can you just go back to previous one? Yeah, sorry. Yeah, so the VCIP was introduced, and that's where you see that most of the regulated entities put up the VCIP process as a part of the journey, where the end-to-end the digital processes that they were emphasizing on, right? And then also the periodic updation of the KYC, where that Aadhaar-based OTP KYC can be used to do the periodic KYC, and this is based on that risk categorization of the different customers, be it on the high, medium, low, and the banks has to, or the NBFC has to lay down that what is the risk categorizations, right? And this first time also AML KYC guidelines, where the RBI emphasized on the uses of the new technologies, especially on the AIML capabilities can be used. And that's where when you hear Abhishek that you will talk about that, how they are trying to make the better use of the data analytics into the whole of the process. That's where RBI emphasized the use, be it on you're building a new product or using in the journey part of it. Abhishek, can you just go to the next? And the quick summary, if I try to talk about some of these other policy changes, where that board level, the KYC policy has to be there. So I'm just talking about the summarization of some of these changes which has taken place over a period of time, right? So risk-based approach, like which customer, which segment, which product can have the high risk or the medium risk. And then based on that, or say, for example, fintech relationship, which level of the fintech relationship. So need to understand that what are the risks behind those product segments and different dimensions, and then build on a KYC policy around that. So that's where that RBI emphasized upon that KYC policy and the risk-based approach to the whole of the process, right? They're also having a designated director and principal officer. The first time they said the KYC for the nodal officer there has to be there, which is at the designated director level, which ensures that overall the compliance. And also you will notice that the majority of the regulation which has come in, it doesn't only applies to the banks, right? It goes beyond that small finance bank, the NBFC also upper layer, the middle layer. So it's widening that entire scope. And look at the other, like say payment aggregator, payment gateway. So every entities which is coming under the regulated purview of the supervision, they need to comply with this whole of the guidelines, right? Customer acceptance policy, where that exclusive the consent structure has to put in place. Suspicion of money laundering, and this is very the core of that, trying to stop that any kind of the misuse of the money flow into the whole of the systems, right? So in government and the country ecosystem should not be used for. That's where they're trying to emphasize and continue to enhance about the reporting. Good emphasis on that risk-based approach for the policy. So you need to have build on a good risk management framework around to build that in this policy and implement those policy and the customer identification procedures, like especially for the international money transfer also. So just go to next. So I'll now hand over to Abhishek to just walk us through the deeper landscape and how it has evolved over a period of time. So over to you, Abhishek.
Thanks, Shashank. I do see that there are questions that are coming up in the Q&A box. We will Please feel free to add them through the session. We will take those up and we will respond to them either in the middle or at the end. So just don't hold back from your questions. It's always good to sort of put them out so that we can respond to them. I would like to finish this section before I start taking up some of those questions. This particular slide tells you really the complexity when it comes to AML compliance in India is shown. If you look at the number of laws, these are the ones that you see on top are only a limited number of laws that have an AML component to it. So AML is not just covered by PMLA. There are also many other laws that have either sections, subsections, guidelines, or connections to AML norms in this country. And because of that, the RBI is not the only regulator out there which is looking at AML. While FIU is an agency, you've got many other regulators. In fact, most regulators, most large regulators in today's date who have a financial aspect to them or financial control aspect to them have some powers under the PMLA Act and other acts. What that means is if you're a fintech which is exposed to, say, insurance or banking, or you're exposed to trade, or you're exposed to even forestry or agriculture, there is going to be some exposure and some compliances that you have to maintain when it comes to AML. And all of this is very relevant. And as we move ahead, we'll show you that India has till date, or since the last 10 odd years when AML has started becoming a big issue in India, we've had 628 actions and events that regulators have taken around AML non-compliances. 458 organizations and entities have been fined. A total of $55 million of penalties have been levied. And about 86 individuals have either been implicated or have been imprisoned. That imprisonment rate and implication rate is only going up. In fact, as we move ahead, what you will see is, I want you to start looking at 2020 and beyond. India has the third highest number of AML actions taken by regulators in the world. Number one is the US, number two is the UK, and number three is India. After the lull that we saw in 2020 because of COVID, you can see that the number of actions have only increased year on year. And already in 2024, within the first couple of months, 13 actions have already been taken. So while the penalty amounts are lesser in this country as compared to, say, the US and UK, where you have billions of dollars getting levied in certain cases on AML non-compliance, in India, the action is actually more stringent in terms, not so much in terms of fines, but in terms of reputation risk. And now increasingly, as we are seeing, in shutting down businesses as a black swan event that these businesses are facing. So AML compliance is clearly, from a trend point of view, is clearly on the uptick. When we look at the key regulations that are governing fintech in India, there is the RBI regulations, there are SEBI regulations, there are IRDA regulations, and there's MeitY regulations. Those are the four big set of regulations that one would need to be concerned about. Your legal and compliance folks and risk folks need to be concerned about when designing products, when engaging with customers, when setting up an AML program, when reporting to customers or reporting to regulators, sorry. And therefore, these regulations, these regulators should be top of mind when you're trying to build a program, AML program. And what we'll show you as part of this presentation, as part of this webinar, is also what an AML program looks like. And I think that's going to be a big takeaway for you. What are the different parts of an AML program that you should have in your organization to make sure that there is you have compliance coverage? I want to quickly take you through and spend a minute here on RBI Master Direction, not so much because I want to talk to you about the specific elements of what has changed. But if you see the top line on top, there was a change in 2016, then a change in 2019, then a change in 2020, and a change in 2021. And then starting 2023, the RBI Master Direction for KYC, something that is followed by the regulators, has changed a total of 6 times. 6 times in under 1.5 years. So it had changed 6 times in the 10 years before total. And now in the last 1.5 years, it has been updated and modified and changed 6 times. And what that tells you is, number one, the regulators and agency are updating, upgrading, and enhancing regulations at a frantic pace. Number two, they expect you to comply. And number three, they are now upping their game to meet global standards, fatter standards, and other best practices. Something that was usually a gap when it came to Indian fintechs and Indian regulated entities. So the RBI Master Direction, while it is a great read, the number of updates shows you the intent of the regulator and the direction that they're taking. And this is a big takeaway for everyone here. And now we can move on to fintechs. How does AML impact fintechs? I'm going to ask Shashank to take over this section.
So maybe, Abhishek, before that we get into the fintech, couple of minutes, we can pick up a few questions.
Sure.
Yeah. So I think Wafadal is trying to understand that how do you ensure risk management for businesses in the entire KYC process?
So if I can take that off, it is a very expansive and nuanced, and I'd say it's a simple question with a complicated answer. And it's complicated because there are many moving parts. So what I'm going to request is, why don't you wait for maybe the next 10-15 minutes while we get to the part where I can show you what is required in an AML program, all the components, because that will give you an understanding of all the working parts and moving parts that need to be in an AML program for you to effectively ensure that you have risk management and you have coverage in your business. So the answer is there in this webinar. It's just not a simple 2-line answer that I can offer you at this point of time.
And I think next question is also hinting towards, I think we'll have to wait, because it's all about that. How do you build your AML and strategies around this evolving risk? So I think we'll just come to the place and then we maybe come back and pick up both the questions, which point toward that, how does risk management taking care of the AML? So I think, guys, and we definitely don't want to, we will come to question and we'll also open, we want to have more engaging discussions. So now we have understood about the whole of the AML. And now let's look at that, how this complexities has increased when the banks and fintechs or the NBFCs fintechs has started working into that. So if you look at it, how the entire fintech ecosystem has evolved over a period, and where, like, say, if you look at it, you have that evolution of the India stack. Look at that, either putting the identity rail through that presenceless and paperless layer through the Aadhaar enablement, right? I think that's a major change. And then on top of that, laying down the cashless layer through the NPCI, putting out that different real-time payments infrastructure, be it on the starting with IMPS to AEPS, and then slowly going to the UPI, and UPI, the way it has changed the entire digital landscapes, right? And then also the data sharing. So now picking up each one of thing and see that how the layering of the innovation has taken place, like coming that on, just go, Abhishek, just quick, yeah, sorry. So Aadhaar, then Aadhaar get extended toward that DigiLocker, that e-sign, and then digital verification, eKYC, e-sign, as well as the DigiLocker. And all this component adoption has been continued to increase. And these have been very major factors in setting up the digital journey that we keep on talking about today. So onboarding the customer directly from there, wherever he is there. And payments rail, you have IMPS, then APS, and then so primarily we have spoken about, and then continue to enhance that impact of the UPI on the opening of the credit lines, right? So last year, you would have seen the circulars that enabling the credit lines on the UPI where the lending is coming. And the data sharing rails, which is consent layer, which has been the last as a layer, as a part of the India stack, which started putting that consent structure, and in forms of the account aggregator, you would have seen that now it has been laid down that using the consent, how do you allow the financial information service provider to share the information with each other, right? So now, Abhishek, can you just go to the next slide? But before we get into the challenges part of it, let's understand that why this bank and fintech partnership has evolved. And in the last 10 years, we have seen the massive partnership, new innovation got created. And because both have seen that there is a strength in each other, right? So if you look at the financial institution, be it on the banks or this NBFCs, large NBFCs doing lots of collaboration and the partnership with the fintech, including the mid-size of the NBFCs also. But if you look at what the NBFCs or financial institutions bringing on the table, that definitely they're bringing that broad customer base, which is loyal customer base that they have created over a period of time. They definitely have an advantage of the capital, right? Because they've been in the business, they've been into profitable business. Very importantly, if you look at it, they bring the regulatory experience because they are anyway regulated entity. They go through the continuous regulatory scrutiny. They have the kind of the team and the technology infrastructure in place, which enable them to respond to the regulatory requirements. And they have a distribution capability to the branches. But while if you look at the fintechs in the last 10 years, they also created their own strength and which started complemented banks their own strength. So be it on their innovation to create new product offerings, and we might have heard like BNPL coming into the picture, or the merchant cash advance kind of the project, neo banking. These are the new innovation was created with the help of the fintech. And every innovations, if you look at it, has worked with the banks, right? They bring definitely the agility, how to change, how to respond to the new requirement better. They understand the customer experience. They know that how to use the technologies. They understand that AML, that the APIs uses. So they have very deep on the cutting edge technologies. They know that they don't have time. They want to work fast. They bring the new innovation, fail fast, and then learn, right? And keep on moving. So that's where they're, and distribution, they have gone through the digital marketing, right? They understand how to reach out to their customer digitally. While banks has the distribution network through the branches, fintech able to create the distribution network through their platforms. And how each other's strength has started contributing, definitely new business models, which I was talking about, that digital lending models. If you look at it around the BNPL, the credit line, or say merchant cash advance, or to the neo banking, embedded finance, these are the new models were created. Customer trust, where because the fintech is bringing that technology layer and the bank's partnership is providing that trust layer on top of it, right? Customer-centric products created. Fintechs and banks, when working together, they can use the better use of the data, which is fintech is also bringing this layer of the data, and banks or the financial institution also, and how collaborative they can make a better use of the data. And definitely in the whole of the process, how do we help the cost reduction? So that's an opportunity got created for them. Now, but and some of the successful model we have seen in the industry, but it's not just hunky-dory, right? There are some challenges, right? Any bank fintech partnership goes through the massive process because there are challenges at both ends. I'll just talk about some of those challenges, and then we go into how to build the programs, right? So there are many challenges. Integration among the systems. So fintech is a digital platform. Banks has their own stack. How do you do the integration? Because most of the time, financial institution may not be ready on the APIs. Then if you look at some of the other dimension like regulatory compliance, because they need to go through the strict compliance. They're talking about the bank perspective. Since they can't just leave everything in the hand of the fintech, because ultimately regulators will respond them that you are responsible for ensuring the KYC. So that's where they will have the challenge. Data security and the privacy and the fraud. These are the other challenges, like because they need to ensure, because now the customer is engaging on the third party layer, right? But still, they need to make sure that the customer data security or the fraudulent transactions get controlled. And as well, the risk management, right? These are the product risk. While there are customer reputation, scalability, reliability, those are some of the challenges from the bank side, because fintech will suddenly span up the business, but how the bank's own legacy infrastructure or the backend infrastructure is sustained. But some of the major challenges, if you look at it, revolve around the compliance, making sure that whatever the product, the journey has been created, the compliance, the data security, the risk management has woven around it. So that's more of the challenges from the bank side. Well, there are challenges of the fintechs, and that's where the second part of the session that you look at it, that solution are trying to solve both the end of the problem, right? Banks challenges as well as the fintech more from the compliance layer, right? So fintech has also challenges that how to able to work with the bank's own challenges, how to able to go through that bank's own technology layer. Then due diligence process, right? Because banks has a typically very strong due diligence. Again, and most of the due diligence process, if you look at it, revolve around the compliance, security, and risk management, and how the fintechs are ensuring those things. So fintech is always a challenge that whether they will go through that stringent due diligence process for the banks, right? User experience, because now you will have to manage through the diverse interfaces. So that's where they face that key, how the customer going to engage, because what API bank will provide, they will have to build the interfaces according to that. So these are typical challenges for fintech. While partnership dynamics, who is having a better control over the customer, who is managing the, those are the challenges we'll keep on tussling between, right? Then products is market fit, customer onboarding, whether the journey is this, the way fintech wants to have a journey without any frictions, quick and instant, but banks will try to make sure that those are the critical elements of compliance. Security comes into a part of the journey, which may create a bottlenecks to the journeys, right? But again, massive impacts comes under the due diligence, because it's not only they have to go through the due diligence of the banks or the regulated entities in terms of their ability to respond to the compliance or the security requirements or the fraud management or the risk management requirement, but they have to demonstrate through the technologies, the processes at their end to give the comfort to the banks that they can respond to those compliance requirements, right? Because rest of the other things is manageable through the some of the tweaking in the processes, but not at this space, right? So just Shekhar, if you can move to the next. Yeah, so that was the setting and context of the AML and how the AML or the compliance at large has a critical to the both of the bank and fintech relationship. So over to you, Abhishek, and you are the best person to pass through that process. Yeah, thanks.
Thanks, Shashank. So till now we've spent some time in setting context on AML, setting context on fintechs, the challenges. But I think the one burning question that many in the audience and many of our clients and partners end up having is saying, all right, now you set the context, but where are we right now? What is the state that we are currently in? What are the challenges that we are facing? And how do we solve them? And now we are going to spend a significant amount of time addressing those. And I know that there are more questions that are piled up, but looking at many of those questions, I think I will be able to start answering them with some of the material that is there in the slides going forward. So Shashank had touched upon this, but let's be real about why is there stress, specifically AML compliance stress, when it comes to fintechs. That stress is there because fintechs have to deal with banks or partners. They have to deal with regulators increasingly, and they have to deal with customers. They're effectively dealing with multiple parties to make sure that their business model works. And all these parties have different priorities. They have different importances. They have different This is a very valuable business model for many fintechs because they're able to capture value because of the non-alignment between these three different parties. They're able to capture value. But all of these three parties have very, very different requirements. So what is there? Number one is, I think over the last couple of years, the regulator has made it very clear that fintechs will be considered independent of banks as it relates to managing their own AML programs. For the longest time, fintechs had said, our AML is done, or our KYC and AML checks and others are done by our banking partners or other partners. So we really don't need that kind of cover. And the regulator has come out and clearly said that is not the case in most instances. Fintechs need to have their own AML cover, their own AML policies, their own AML technologies, their own AML capabilities. So because of that, now banking partners expect fintechs to have a certain level of compliance. Otherwise, banks get impacted. And so there's a lot of pressure coming from banks to enhance compliance. In fact, there are very well documented cases where banking relationships with fintechs and partner relationships with fintechs have broken up or have gotten severely degraded because AML compliance is not in place. Similarly, we can now see regulators taking so many actions. And I'm not just talking in terms of AML on compliance, but also actions in terms of shutting down businesses, putting a rest to businesses, threatening to take away licenses and others, because they consider it very, very important. So there are pressures now coming from regulators where the regulator is very clear that they are concerned about making sure that there is no structural issues and ultimately the customer is secure. So they are going to do everything in their power to make sure that those two objectives are met. There's no structural issue and the customer is secure. And in both of those, AML and fraud effectively plays a big impact. Now, the customer wants to reduce friction, but AML programs necessarily add some layers to it, which doesn't mean that there has to be friction, but there definitely has to be more design that goes into it. Then there is always that push between innovation versus regulation. Every time you want to innovate the business model, regulation comes in the middle. Increasingly, fintechs are now realizing that cost and margin pressures are there because there's so many fintechs have gotten into the same set of spaces. And as cost and margin pressures increase, compliance takes, in certain cases, a hit. That is a bad idea because compliance is not just a simple cost item. It can be a black swan event where the entire business can get completely shut down, as we are seeing now. The next is the need to move fast and break things. Things great for innovation, but regulation does not work like that. It does not work by moving fast and breaking things. It has to be kept in a separate bucket. And finally, product and business stakeholders internally, because they're driving P&L, they're driving revenues, and quite rightly, they're driving the business. Many decisions end up trumping risk and compliance within an organization. Those are some of the challenges that people are seeing when it comes to fintech relationships. Let's start by first taking a case study. Now, we are all aware of this fintech, but this fintech, which is one of the largest in the countries, has since 2018 had multiple instances where the regulators have come in, identified gaps, imposed fines, publicly named and shamed, taken actions, released press releases, put people to task, and have over the last 5 to 6 years, slowly but steadily escalated the gaps. They've identified them, they've escalated them, and others. But today, in 2024, this particular fintech, large fintech, is today staring at possibly closure of certain businesses, withdrawal of licenses, massive reputational risk, and really erosion of investor value. So I understand that many people, especially on this webinar, may be looking at AML as an operational challenge. But as Binance has realized, as many of the large banks in the world have realized, as fintechs in India have realized, this is not just an operational challenge. It is a business problem because businesses can get severely impacted. And it can take forever to come back up to the level that one would want to get to. Investor confidence gets shaken, investor value gets eroded. You're on the many companies are in the doghouse as far as the regulators are concerned. So no new licenses come to them, no new provisions get this thing taken up. International partnerships go for a 6, banking relationships go for a 6. All of that gets massively impacted. We are seeing this happen in front of us. And if you saw the graph initially, you can see this is not going to reduce anytime soon. It is very clear to us globally that regulators and FATF and others have moved or have shifted a certain set of their resources to review fintechs, NBFCs, cryptocurrencies, and many of the other financial institutions that would otherwise not come in the net of AML investigations. This is going to continue. That trend is absolutely clear. So now, why is there compliance stress? Why is it that people are seeing so much stress? And some of you may be seeing it in your own organizations, but you're not able to understand why is it that the regulators suddenly become so active? Why is it that we're seeing so many complaints? Why is it that we can suddenly see so many issues come up in the news? And there are some very simple reasons to it. Number one, the Indian regulators, as I showed you with the RBI AML KYC master direction, has had frequent regulatory updates. And now there are multiple regulators in this country focused on AML. And what that means is, from a time when regulatory compliance was relatively easy, the goalpost keeps shifting slightly, but continues to shift. And fintechs need to invest in technologies, capabilities, people, skills to make sure that they're also shifting their goals accordingly. Now, reporting was not just to the FIU, reporting is to multiple regulators. There are many of you fintechs out there who've got multiple businesses, wealth management businesses and P2P lending businesses and NBFC businesses and insurance businesses and others. And you have to deal with multiple regulators. And what that means is they all need to be satisfied as far as reporting is concerned, because AML comes under all of their purviews. The second thing that has happened is, which I'm sure many of you know, is there has been a long, ongoing, very critical, very focused FATF review, Financial Action Task Force review in India, to look at the country's readiness on AML compliance at a country level, not just regulation, but at a country level. The FATF has gotten, the Financial Action Task Force has gotten very active in grey listing countries that are not meeting AML compliance norms. And what does that mean? It means it becomes that much more difficult for that country to trade with other banks, to trade with other countries. Cost of dollar goes up, cost of trade goes up. The banking and fintech ecosystem gets so much more under pressure. It's overall bad for an economy to get into the grey list. Ask the UAE, which just recently got out of the grey list, and they have made massive efforts to get out. So no country wants to get into the grey list. And that starts with the government and the regulators. So they are going to push, push focus down. They're going to push all these new regulations downwards. And that's the reason why many of the fintechs and others are feeling the pain. But separate from that is this current Indian government and dispensation clearly understands, number one, money laundering is bad for the economy. Number two, TF, which is terrorism financing, is bad for social stability. I'm sure many of you would have heard about how your stone pelters in the Kashmir Valley were being funded by people who are doing effectively money laundering to push all that cash so that every person who was pelting stones was getting 300, 500 rupees. That money laundering was happening through fintechs. It was happening through the banking channels. This particular government is very, very careful about stopping that. So they've taken actions on NGOs, they've taken actions on terrorism financing, they've taken actions on banks who got lax AML norms. And also they understand that they don't want to lose taxation revenue, something that gets lost if there is AML non-compliance. FATF focus now globally is not just on banks, it's now on fintechs. And so you will see that not just in India, you're seeing that across the world. India has one of the most fastest growing and thriving fintech ecosystems in the world today. Thanks to our economy, thanks to our innovation, thanks to the massively untapped, underutilized sort of credit in this country. But what that means is there's going to be that much more pressure on fintechs. Fintech types, the types of fintechs, the values and volumes, they've grown very fast. The RBI recognizes it. So you've seen certain regulations last year where they put higher weightage on unsecured loans. Those are because they understand how fast things are growing. And so do the regulators. Within fintechs across the country, because there are now thousands of fintechs. And I just don't mean, when we talk about fintechs, many NBFCs are becoming fintechs. Many of the other payment providers are fintechs. They're effectively financial institutions that are technology enabled, deep technology enabled. They unfortunately lack a culture of deep compliance. And what that means is not that whether you have an AML officer or an MLRO or not. What that means is, does the senior management understand what AML needs to, needs to happen in AML? Does senior management needs to know what needs to happen in AML? And those are issues. So there are many fintechs that I have been to where there are no dedicated budgets for AML compliance. And when I say budgets, I mean there are no budgets for transaction monitoring systems. There are no budgets for screening systems. There are no budgets for hiring of AML talent. There are no budgets for policies. And so when AML compliance has to be done, what means is that that finance team then therefore gives you a very small budget to work out of, and that means most fintechs and others end up either buying very low quality tools, something that we cover over here, or they end up not complying at all. In many cases, investors have not understood why is AML non-compliance so important. And hopefully now with some of the activities that are happening, investors will understand that, hey, if my investee company is not complying to anti-money laundering norms for India, it can be a black swan event. My business and my investment can be massively eroded or shut down. That's something that is why also there is no stress, because if it starts at the investor and board level, you can see a lot of things start getting settled down. Unfortunately, we don't see that happen with many fintechs. The number 10 thing is, and this is very unfortunate, there's a proliferation of cheap or inadequate tools, and there's mis-selling of technologies happening left, right, and center, especially in India, where now suddenly people need to comply. We want to make sure that we are complying. So I know of organizations who will mis-sell, who will sell something very cheap, or who will sell something very inadequate. And because there is not enough knowledge internally, people will buy it thinking that they have a screening system, or they have a transaction monitoring system, or they have a case management system, but it does not work. It does not adhere to the norms that are required by the regulator. And so you may have bought something, but you're not really complying, and that leads to stress. And today, for example, when we go out and deliver our tools and technologies to many of our clients, they're usually transitioning away from low quality tools and low quality technologies, not because they want to buy something expensive, but simply because they want to make sure that they comply. And finally, AML compliance in fintechs today, in many cases, is being managed or is being decided by non-compliance folks. The folks in digital transformation, digital channels, product development, they do a great job. But in many cases, they don't have the knowledge on what is required in AML compliance. And so that becomes a slight blocker. So these are the reasons why there is an AML compliance test. And the reason why I'm putting those out is, if you think in your fintech, one or more of these issues are there, you will be able to identify the genesis of the problem. Why does it happen? Now, I want to talk about the impact of low-cost tools. On the right-hand side, you will see an Alto, and you'll see a Toyota, and you'll see a Lamborghini. And the reason why I'm putting those out there is because many AML compliance tools in today's date can really be tagged or slotted in these three. When we as product folks or compliance folks, we look at AML tools or AML technologies, we say, there are four wheels, it'll get me from point A to point B, therefore Alto is fine. And that has traditionally been the approach when it comes to buying these tools. But what happens with low cost is that they are also low quality, which means just like with cars, you don't get all the airbags. There's not. They're very low rated, or zero rated, star rated when it comes to crash. They don't. You suddenly realize you don't have power windows. You suddenly realize you don't have many of the features that you wanted, because you are trying to run a high quality business, but you've bought the AML compliance tool, which is very low quality, low cost, because that's really what you thought was required. On the other spectrum, you've got, Lamborghinis, and I would not recommend that for most businesses, especially in India, because our per transaction cost in this country is very low, relatively low when it comes to European and American businesses. And so my philosophy personally is to look for tools and technologies that are like Toyotas. They're trusted, they're well refined, they're enhanced in others. Sorry, Shashank.
Yeah, Abhishek, since we are already 3:45, so I may suggest that we just cover up the remaining some of the slides, because we have lots of questions, and now some of this is already getting answered, but there are some very interesting questions also.
Understood. So I'll quickly tell you what.
Sorry. And the guys, our team has put up the feedback forms. Please start sharing your feedback. That's always helpful for all of us. Thank you. Abhishek, sorry, continue, please.
Sure. So quickly, what is the impact of low cost tools? You get lots of false positives, which means you have to spend more cost and resources to clear out those alerts. Limited functionalities, so you don't get enough compliance coverage. There's lack of coverage, means you have non-compliance. If you get poor data quality, and data is very, very important when it comes to what you need to do when it comes to screening and transaction screening and others. That's very, very important. Otherwise, there's screening gaps. For example, if you don't have good PEP data or good sanctions data or good adverse news data, you will have holes. Not all data is exactly the same. Inefficient workflow means you'll have to add so many more people to manage things. If your tools are not tested, validated, and certified, you don't know if they even meet AML requirements. If the technology doesn't scale, which means today, let's say you're a small startup and tomorrow you want to sort of scale up, you don't know if the tool will scale up. If you today have 10,000 transactions and tomorrow you have 1 million, you don't know if the tool will scale up to 1 million. If these tools aren't built up to global best practices, tomorrow when you want to move outside of India and to the Middle East, or you want to move to South Africa, you want to move to Indonesia and Vietnam, the same tools may not be able to scale because so you'll have to end up buying more tools. If you don't get support and services, tomorrow when the regulator decides to change some new rule or get a new rule or get a new transaction rule or a new threshold or others, suddenly you're sitting in Turkey and you're sitting like a duck because you don't know if your partner will be able to support you. And finally, if these tools don't help you in managing customer experience, then you'll just end up losing customers. These are some of the impact of low-cost tools and why I definitely recommend staying away from anything that is marketed as cheap. That is something when it comes to compliance. Think of compliance like going to a doctor. You do not want to go to a doctor that is cheap. You want to go to a doctor that will help you solve the problem that you're facing. So how do you solve the AML gaps? Number one, make sure your organization assigns budgets and an AML POC. If you have assigned budgets and an AML POC, you know you can spend on the adequate solutions. Number two, whatever you choose, whichever vendor you decide to go with, whichever supplier you decide to go with, make sure you have access to the entire RegTech stack. And I'll show you what the RegTech stack is. But basically, you need to have access to the data, the technology, the support, and the intelligence, all of it. Don't just go for one vendor who's just giving you the data or just giving the tech. That will lead to more problems. Number three, if you haven't started anywhere, start with KYC and screening. Best place to start. You don't have to get worried about starting with everything, and we'll show you what the AML program looks like. Start with the simple basic things. Start with KYC, start with screening. And that's a good starting point. Number four, when you get a technology or a solution in from a provider like myself or say someone else, please make sure you test, validate, and certify the technology. There should be some certification there. ISO certifications, SOC 2 certifications, others there are available there. They will really help your business. Number five, have a roadmap for what should be there in the AML program. I'll show you what that AML program looks like. And number six, maybe it's a partner like Digital Fifth, maybe it's a partner like a consulting partner, but have the right partner to guide you on your AML journey. Have somebody to guide you. Either have an internal person who's experienced or an external one, but let them guide you on this journey because there is not enough knowledge about it currently in this country. What are the components for an AML program? Now, quickly, I wanted to share this to you, and I know we're sort of entering that. If you see, these are the different elements for every AML program. If today, now, all of these are not equal. There may be equal boxes here, but they are not all equal. So you will have in your organization, when I said you need to have a pathway to AML program, it means over 1 year or 1.5 years or say 2 years, you need to have the ability to add all these elements. Start with policies. Start with making sure your senior management oversight is there. Get name screening in, get KYC in, transaction monitoring in, and then you can move up beyond. But all these elements in a limited fashion for a small fintech or in a big fashion should exist in your ecosystem. And this is how you will go out and solve them. And all of these in one fashion or the other are required either by global best practices or by the regulator in India. This will give you complete AML coverage. Right? Now, what did I mean when I said the RegTech stack? The RegTech stack is effectively 3 levels. data, technology, and support. All the different data sets, so PEPs, sanctions, country watch list, global watch list, vessel tracking, exclusion list, and others that are required for name screening, payment screening, due diligence, and others, you need to have access to those. If you don't have high quality access to that data, you are in non-compliance. You don't know what you're screening. Number two, you need to have the right technologies, name screening, payment screening, transaction monitoring, entity management, customer risk rating. Again, these are not all equal. Some of them could be very small modules. Some of them could be large applications, but you need to make sure that they are there in place. Otherwise, there could be holes in your AML program. And you need to take advice from an organization or from an internal consultant or an external one to be able to say, all right, do I have these or not? And finally, support. Do I have somebody to help me in implementation? Do I have somebody to help me in due diligence? Do I have somebody to help me with training? Do I have somebody to do an independent testing? This may seem like a lot, but it's really making sure that you have a checklist of all the things that should be there in your AML program for you to have confidence that generally everything is covered. And finally, what are the key takeaways? And then after that, we will take up your questions. First, global regulatory and geopolitical movements are behind AML movements. This is not an India thing. This is a global thing. This is going to stay. Number two, in India, fintechs have been identified as money laundering and terrorism financing drivers. This is a known thing. The regulators understand it. The agencies understand it. The investigative agencies understand it. Therefore, you will see more pressure coming to fintechs. Number three, AML is no longer a tick mark activity. It used to be the case till 2021, 2022 maybe. It's no longer that case. Your businesses could be shut down. Your licenses could be taken away. Your reputation could be massively hurt. You could be ticked off. There could be fines, penalties. People could be asked to leave if AML compliance is not in place. That is a clear trend that regulators are showing in today's date. Number five, if you don't have dedicated budgets, talent, and roadmaps, that will continue to cause you stress. The stress is not going to go away. That's number five. Number six, low-cost tools, which are marketed as low cost, are going to lead to high-cost outcomes. You're not going to be able to save money on them. Number seven, get the right partner, get the right tech, get the right data. Very important. Number eight, you need to make sure that AML applications and technologies that you get can scale with your business, scale up and scale down. Number nine, you have to have a roadmap to make sure that you are on track to add all the elements that you don't. And finally, AML is always work in progress because regulations will keep changing, compliance norms will keep changing, your business will keep changing. And those are the key takeaways. So with that, I'm going to stop sharing and we can now take up questions that are, I see there's a whole bunch of questions that are there. Shashank, if you want to start and then maybe, or maybe I can take.
Yeah, I think you can just quickly guess. I think first one, that primarily the role of the risk management in the whole of the setting up, the building that KYC strategies, right?
Right.
First two questions, yeah.
And I think those, if you look at the AML program that we've showcased, that is how you ensure that you will manage your risk and manage compliance. All those elements in some fashion or the other, depending on your business, need to be in place, or at least your senior management has to be aware of it. The second question is, with the recent rise in NBFCs and growing complexity in financial transactions, I'm interested in learning how compliance professionals are adapting their AML and financial crime strategies to address these evolving risks. Specifically, are there any innovative approaches or technologies being employed to enhance detection and prevention efforts in this space? So a couple of very interesting things are happening. Number one, organizations are making sure that the following things are automated within or technology enabled: name screening, transaction screening, transaction monitoring, fraud monitoring, customer risk rating, and case management. These used to be done, many of these used to be done in Excel, but are now technology enabled. Plus, many of these technology are now SaaS, so they're on the cloud, so they can scale up and scale down, and you don't have to worry about doing on-prem deployments. And finally, there are now layers of machine learning models and even AI models. So we want to be very careful about those in trying to enhance detection, create SARs and STRs, and then file them. So those are some of the things that are happening. Then there is a question which is saying, hi, what are the ways to address positive confirmation in case of non-face-to-face mode KYC compliant? This is not strictly AML, Anjali, but from what I understand, you will have to take an address proof to make sure you either have, say, through a letter or in-person visits, and others to take the positive confirmation for non-face-to-face mode KYC compliance. Though in this particular case, I will not be the expert, but there are others who can definitely answer that question to you. Then we've got a statement from Nassima. Thanks, Abhishek and Shashank, for scheduling the session. It is an excellent platform to relook and review internal process on AML KYC. Thank you so much. Then we've got another question, which is, how many warnings do you get before any action? It's really anybody's guess, to be honest. I mean, if we knew that, then I'd probably be a millionaire many times over by now. But I will say this, that at least the inputs that I'm getting from many of the partners and customers that we work with is this. There was a time when the regulators would informally tell you what they expect you to do and what they don't expect you to do. And then once they waited it out, and if things hadn't gotten better, they would formally take some actions. I think that laxity and that rope is now become much shorter. So what would take you, you probably get a warning in the first go itself if it's a massive violation. Now, next is anybody in jail? Can you give me some names of people? So while you'd written that, I'd already taken out a couple of people. I just did a simple, lazy Google search. And a month ago, an IRS officer has been imprisoned along with two people. You can look that up on Google News because of an ED case. Those are theirs. And also, as of right now, if you think about it, because AML is now being actually applied in many of the financial crimes cases because of predicate offense issues. So today, even say somebody like Naresh Goyal is in court because of associated AML issues. So he's also in jail. So there are many people who are in jail because AML actions are now being tagged extensively with many of these things. Next is Prerna. Please advise on the below regulation as per RBI Master Direction KYC 2016. Robust software throwing alerts when the transactions are inconsistent with the risk categorization or updated profile of the customers shall be put into use as part of effective identification and reporting of suspicious transactions. However, no such software is found in the company. Further, these guidelines are not documented in KYC policy of the company. Further, RBI has levied penalties on 9 banks, 65 lakhs for non-compliance of these directions. You're absolutely right. What that means is effectively a transaction monitoring system. In fact, if you look at the latest regulation right now, they have specifically called out the need for a transaction monitoring system, an automated transaction monitoring system, something that did not exist in the previous versions. So many people were happy doing it on Excel. Now you need to have a transaction monitoring system. It is a clear expectation. The regulator walks into your regulated entity. They want to see a transaction monitoring system. Other than audits, is there any way to keep monitoring on a regular basis? Well, beyond audit, there is a function that I've seen in certain companies which is called the AML assurance function. The AML assurance function is effectively like a QC layer to make sure that all the elements of AML are going in the way that they are. Usually that's headed by a senior person who's worked with the RBI or worked with some of the other regulators in the past, and they can give you the assurance that things are working as they're supposed to. You can also hire consultants and external advisors to help you with this. Next is, are there any real-time payment screening happening in place? The answer is yes, Praveen. They are. Payment screening is a big element, especially for cross-border and for even domestic transactions today's date. It is a variant of name screening and transaction monitoring. The combination of those two is called payment screening. Yes, they are happening. Rajat Kumar says, why are Indian banks not using technology for AML investigation? Actually, Rajat, many are. They're just using very old or inadequate AML technology. And that is the essential. That is the problem in today's state. They're just not keeping up with the times. Some are not. Many of the non-scheduled ones are not, but they will probably also come under the ambit very soon. As per KYC MD, PEP is defined as a person who were associated in foreign country. What about applicability to Indian scenario? Well, for that, you'll have to change the PMLA Act, to be honest. But as I understand it, most organizations in India today are also tracking India PEPs. The regulator and global best practices say that domestic PEPs should also be reviewed. But when it comes to the law and to the master direction, only foreign politicians of a certain stature are considered PEPs.
Abhishek, I think we are on the last, but we'll
sure.
just extend 5 minutes for few more questions to take it up. But meanwhile, again, request everyone to fill up the feedback form. The team has already put up the feedback form, and those who want to connect, that's the option is there on the feed. Please do that, and then either from our team or the Abhishek team, someone will reach out to you. Thanks, Abhishek. I think let's continue. A few questions.
Sure. So there's another question by Praveen. Bank fintech partnerships. Who owns and who does AML transaction monitoring process when customers are onboarded by API? Would it be bank or fintechs? Well, I would go out and say it depends, but in most cases, both individually own it. Because fintechs don't have an exclusive partnership with the bank. The bank does not have exclusive partnership in most cases with the fintech. They usually have multiple partners, so they need to do it separately. And as I mentioned initially, the regulators are now very clear that everybody needs to own their own AML program, so it would be independent of each other. Let's move on to the next one. Narasimha says, will we observe an expansion of the scope of account aggregators in achieving uniformity in AML and KYC diligence? Narasimha, it depends. It is an interesting thought. We've tried to float it ourselves, but the problem is when AML compliance is done by using risk-based approach, which means customers have to be risk rated, high, medium, and low. Every institution does risk rating on their own, based on their own policies, and therefore the same level of AML and KYC diligence cannot be applied on all. So every bank will, unless until they completely standardize risk rating, which is going to be then in non-compliance with global norms, I don't see that happening anytime soon. Certain aspects like sanctions checks and others could probably happen, to be honest. Next is, how does the right and penalties for AML KYC violations impact the financial health? For example, cooperative banks, I need to know the potential consequences of these penalties. Abhijit, to be honest, not really. In India, penalties are so small that they don't really have a big impact on the financial health of, not to my knowledge, any bank in this country ever. We've seen fines as low as 1 lakh rupees, 50,000 rupees, 5 lakh rupees. And the recent example which happened was about 5 crores, but for a very large organization. This is not the same culture as UK and US, where fines are commensurate with the stature and how big the business is. So they don't have it because here the main aim is to name and shame and maybe to just remove licenses. So actually speaking, if the penalties are higher, you could have more breathing space, but in India, they're not. So I don't foresee too much impact on financial health, to be honest.
Abhishek, I think I think many of the guys who have asked the questions have also stepped out. But on the suggestions, I think they're really good questions. I suggest that our team fill up these questions and put up the responses, and with a short summary of this session, guys, we'll publish this answer on our LinkedIn handles. So definitely we don't want to avoid, but I think few of the guys who have asked the question also have been, people are just stepping out. So so I think we may close it, or
sure.
Okay,
absolutely.
The questions, yeah, that's fine.
No, there are lots of questions. We won't be able to answer all of these for the next 1 hour also. So I do appreciate that. Happy to do our follow-on session maybe in the next couple of weeks to this. But thank you everyone for joining, and I really appreciate it. Thank you.
Thank you very much. Thank you guys, and it was an amazing session. Thank you, Abhishek, for taking your time and spending your insights. Thank you very much.
Thanks everyone. Take care. Bye-bye.
Thank you very much.